It can stay open. All right, we're going to start in just a few minutes. I'm just waiting for a couple of other people, and then we're going to get going. Okay. Today, we are going to talk about property taxes. I'm going to try to make it interesting because it's property taxes. First thing before we get into any of this is that I want everyone to know that you are not CPAs. You probably already knew you were not CPAs, but as a result of not being tax professionals, we are not in the business of giving tax advice. In fact, we never want to give tax advice. We do know stuff about property taxes, and that's important. We give tax advice, or sorry, when we talk about property taxes, we should always tell our clients, we are not CPAs, you should check. And the reason we want them to do that is our information may be totally valid, but everybody has different circumstances. Everyone has different income and assets and tax portfolio and tax situation. So we are not in a position to say that X will work or Y will work for our client, and we are not skilled in the right way, even if we did study taxes. So we want to have some basic information so that we can sort of tell them what they should be asking their CPA and how it'll impact their housing. Is that okay with everybody? Okay. So here's what we're going to cover today. Oh, before we talk about what's on my agenda, for those of you who are in the room, is there anything specific you made you interested in this class? As opposed to just having nothing to do on a Friday afternoon?
All the exemptions, I kind of have some idea, but make sure I know them.
Okay.
Any exceptions or situations where that's pertinent to the estate, like special estate laws and stuff.
Okay, so somebody in the room here, I don't know if Brandon, you can hear, but somebody in the room wants to know about estate, a little bit about estate and special exceptions and stuff like that. So I don't know if we're going to cover that, but we'll see. What else do you guys want to know?
Whatever you got.
Whatever I got. Does anyone on Zoom have any? Let's see. Anyone on Zoom? Prop 9. Annie, I think you mean Prop 19, and we are going to talk about Prop 19.
Yep,
okay.
That's what I mean. Thank you.
Yeah, no worries. We'll get into it. All right. So, and this is not a class on Prop 19, but we'll touch on it and so you know what to do next. All right. So here's what we're going to talk about. And there will be time for us to answer your questions. So first of all, I think it's really important for us real estate agents to understand how property taxes actually work in California. If you're from another state, it works very differently. If you've never owned a property yourself, then you don't have a sense of it. Whereas if you've owned property and paid property taxes, you do have a sense of it. Is anybody in this room a property owner? Anyone here bought property or owned property? Okay, so in the room here, we have more people than not who don't know about it from personal experience. All right, and that's exactly what is a class like this is sort of intended to help with. Because it all kind of, if you've lived it and had to pay property taxes, your perspective is different, right? So we're going to talk about how it works. Then we're going to talk about where you guys as agents get information about property taxes for any property you see online. We're going to talk to you about how to calculate taxes on a sale you might be negotiating. Whether you're working for the buyer or the seller, it's usually of more interest to the buyer. So when you're talking to your buyers, how do you help them figure out how much taxes they're going to owe on that property. Okay. Property taxes, right? We're going to talk a little bit about errors that lenders make and why it's so important to figure this out accurately. Then we're going to spend a little bit of time talking about supplementals. Supplemental property tax is a very confusing area. And we got to spend some time on it so you guys can explain it to your buyers, because it'll bite you. If you don't know about property supplementals, it can come back and bite you later. Then we're going to talk about transfer taxes, which is another type of property tax. And then we're going to talk about Prop 19. And hopefully at the end of that, there'll still be time for some questions. All right. Property taxes. So the first thing to know is that it is based on the county. It is each individual county. We have 57 of them here in California, I think. And each one of them manages the property taxes. When people pay their property tax bill, the check goes to the county treasurer, the county assessor. It does not go to the state, and it does not go to the city or any neighborhood in the city. It goes to the county. In California, we have a very unique tax structure. Hey, I see a future realtor down there with Brandon. Aww. Okay. Sorry, wherever.
San Lorenzo is kind of a special.
No, it's just unincorporated.
Unincorporated.
It's still Alameda County. Okay, so it doesn't matter if the city is incorporated or not, or the jurisdiction. In Contra Costa County, you have El Sobrante. And there are parts of Fremont and Hayward that are considered unincorporated, but they're called Fremont and Hayward. Anyway, it doesn't matter. It's going to come from the county, either Alameda or Contra Costa or whatever county it is. But in California, we have this weird thing that started in the 1970s called Prop 13. So there was this big tax revolt in the 1970s. So what are we talking about? 50 plus years ago, right? And in that time, there was this major vote that happened. And during the major vote, there was a popular vote, and they voted to change the property tax system. And they basically decided that property taxes that were owed would be based on the sale of a property, commercial or residential. And at the time of a sale between non-connected parties, so not inside the family, right? In the time of a sale, that's when the assessment would happen, and the property would get fully reassessed, okay? And Prop 13 said that at that time, it would be based on the... Melanie said it. The sale price. It would be based on the sale price, not based on value as defined by an appraiser, not based on value as defined by the county, but on the actual price the buyer and seller agreed to. Another thing about Prop 13 is it said that the county would be no longer allowed to raise property taxes more than 2% per year. No matter what happened in the market, as long as it was the same owner or the same family and it hadn't changed hands to a third party, the property tax could not go up more than 2% a year. So over time, this has led to some pretty big discrepancies, because in California, especially in the urban areas, property values have skyrocketed since the 70s. So you are going to encounter sellers who are paying $8,000 a year, where the buyer is going to pay $25,000 a year for the same land, because the seller's rate has been going up 2% a year like forever, and the property value has been going up way more than 2% a year, way more, 30, 40, 50, 60%. So sometimes double. So you get discrepancies. Well, sure, the property values, sure. I can look at my own life. I bought a condo in 2012 in Richmond for $135,000. That condo is now worth $350,000, right? And that's a very simple, small price example. You got people who bought beautiful homes in Palo Alto, single family homes. They paid about $1 million, $1.2 million for them back in 1990, 1995. Those no, yeah. Yeah, no, but over time, 2% isn't going to get you there. So the county is losing potential revenue that they might have earned based on a more traditional market assessment. So in many other jurisdictions, every year they do a market value assessment, and the property taxes are based on whatever the current market value is. So they're very volatile. But in California, they're not. They're very much fixed. They only go up 2% maximum per year. And not only that, when the market goes down, you can go to the county and say, I want my taxes to go down. And they will do reassessment for you based on current market conditions. During the Great Recession, we saw a lot of that. We saw a lot of people go to the county and say, this is based on 2006 prices. It's 2009 and my property's dropped a third. I only want to pay taxes based on that. And the counties had to oblige them. That's the basics of Prop 13. There's a lot more to it, but that's all you need to know. The typical tax consists of two components, two big chunks. The first big chunk is called the ad valorem fee. That is the basic property tax. It's usually 1% of the price of the house, whatever it sells for.
Also limit the ad valorem to be 1%, or was it some other?
It's probably that. No, that's the same thing. The direct assessment is the second component of your property taxes, and those are additional charges that the voters have chosen usually, or have been approved by the state legislature or by the local cities, extra fees for various things. So you will see on your ballots, you'll see it on your ballots this June, in fact, where the city you live in or the county says, okay, we want all the property owners to pay an extra $20 a month so that we can fix the libraries, or that we can fix the schools, or we can fix the lighting, or we can do all this stuff. And the voters will sometimes approve those measures. They're called direct assessments. So they go with the land, they go with the property. So when a property is sold, you have the new 1% of the price plus the add-on direct assessments. So we're able to calculate for each parcel, each individual amount, what their tax is, and it varies a little bit. So if you live in one jurisdiction, your jurisdiction may have a whole bunch of add-on taxes, but you live in another one, they'll have either different ones or they won't have very many at all. So the actual property tax on the same price of the house will vary. And that's just something we observe whenever we look at a tax report, which we're going to look at later. So there's two things, the ad valorem, which is 1%, and then the direct assessments, which are the special voted in charges. Property taxes, I just have to see where we go from here because I don't know if I did a slide for this or not. Just one sec. Why is it not moving forward?
Mello-Roos is part of the direct.
Yeah, I'll get to Mello-Roos just a second. My slide deck is not doing anything here. What's going on here? Oops. Oh, there we go. It just went all at once. I had a little burp there. One sec, guys. Okay. Another element of property taxes is the timeline and payment due dates. We're going to talk a little bit about that. And then we're going to talk about impound accounts so you understand how they work. That's important too. So let's just dig in a bit. Ad valorem, that's the first one. Ad valorem is a Latin phrase. It means according to value. And we see this on in the context of this first part of the property taxes. It's the largest component. It ends up actually being 1.1%, not 1%, for technical reasons. Not important. The important thing is you can always count on the property tax for a property being at least 1.1% plus the direct stuff. Okay? The next component is, direct assessments. Several smaller specific fees for local services, fire, water, schools, emergency services, waste management, whatever it is. Sometimes neighborhoods have unique fees just to the neighborhood. Marina Bay in Richmond is an example of where you might see a very unique local fee. Um, and then there's Mello-Roos, which is development specific, where the developer came in and the developer cut a deal. They're going to get to develop this tract of land. And in exchange, there'll be extra taxes for everybody who lives in that area. And that's called Mello-Roos. Because the costs of the actual services has risen faster than the tax rates have risen. So over time, these counties are bled dry. The counties don't have enough money, and the cities, by extension, to be able to provide services. So over the past 50 years, what we've seen is the rise of these direct assessments to help pay for things that weren't getting paid for. And the voters said, we need those things. We need good lighting. We need the emergency services. We need the sewer lines to be cleared to the bay, whatever it was. So a lot of workarounds. One is Mello-Roos development areas. One is redevelopment fees for specific neighborhoods. And then these direct assessment taxes. Okay.
Any of these are temporary only for spirit?
Sometimes they're short term, yes. 5 year, 10 years. They change up. Every time you go to get a tax bill, you'll see the list of the ones that are currently being charged against your property or your client's property.
And I know that Mello, you have to tell your client.
Yeah, that's part of standard disclosures. It's just a standard disclosure.
One not so much, right? Because Mello is this because it's like a lot, usually a high amount, or
your seller's obligation about a property is to tell them everything they know about it, and even if they never lived in it, telling them about the property tax structure is considered required. It doesn't matter whether it's Mello-Roos or not.
like even if it's a low percent.
It doesn't matter. It has to be disclosed. It is usually, I'll show you in a minute where you find it, but it is absolutely of interest to a buyer, and it's a standard disclosure item.
And it's a percentage or is the amount account number?
It's a mix. Let me finish. It'll become clear. All right. Let's talk about timelines and payment due dates. So the tax year, for reasons that are beyond my understanding, runs from July to June. The tax year does not run on the calendar year. It has nothing to do in and of itself of when the property sells, but it runs from July to June. So what happens is the counties calculate how much is owed on a property early in the year, January, February, March. They figure it out. They look at the current owner they have on the record at that time, and they figure out how much is owed for the year coming up beginning July 1st. They figure it out. They don't send the bills until the August, September timeframe. In August, September, they send the bills for the year that has already started in July. The bills are due in 2 equal installments. One of those installments is due November 1st and late December 10th. And the other one is due February 1st and late April 10th. As long as the homeowner gets it in before December 10th or April 10th, there's no penalty. If they do it after that, they pay a significant penalty, 5% of the amount owed, which can add up. I know because 1 year I had to pay it. So you may already be aware of some of this from real estate school, because I know they go over this in real estate school. But can you guys foresee a problem with this timeline in terms of us? Can you even see a problem? What if the county does their calculation in, say, February, and then a flipper buys the property in April, and then he sells it in July? The tax bill coming in August, September is 2 owners ago. That's a problem. We're going to talk about that a little bit later. So when your buyers buy a home, some of them will be required by the lender to allow the lender to pay their property tax on their behalf in 1-month installments. So instead of the 2 installments twice a year, the lender takes care of that, but the owner in this scenario pays 1/12 of it, 1 month's worth, with their monthly payment on their mortgage. That's called, and they put it in a special account, and the bank is required to show you a report, how much is in your impound account, and how much they're saying to the county, and how much you're putting in every time. Not all home buyers have to do this. It's an optional thing. Other home buyers may choose to do it, but it is required for buyers with a down payment of, anyone know what the threshold is? How low your down payment has to be before it's triggered that you have to have an impound account? Any guess? No, 10%. If you are below 10%, 5% down, FHA 3.5% down, 3% down, VA 0 down, anyone who is less than 10% down must have an impound account for their property taxes. If you put in 10% or more, you don't have to. Now, the question for you guys is, why would a borrower choose to have an impound account instead of paying their own taxes?
So they don't forget.
So they don't forget. That is the number one reason. It is a matter of convenience. Why would this be? What would be the counter argument? Why would a buyer choose to not have one when they have the choice and not? What would counter that argument? Huh?
I have the money.
Yes, Melanie's got it. If you have an impound account, and it's worse than just tying up the money, not only do you have to that money go away from you every month instead of twice a year, because arguably, if it's a lot of money, we're talking 5 figures for big expensive houses, you might want to invest that money. And if you invest it for 5.5 months and then pull it out, and then you made more money on your than having gone dribbled away to the bank every month. So there's a financial management piece. You're leaving money on the table if you pay through an impound account, especially for larger amounts. And what makes it worse is the banks require you to have a prepay. You guys are going to see this when you represent a buyer. You're going to say prepaid taxes. The lender says, okay, we are going to be happy to pay your property taxes for you, but you need to pre-fund the account. You need to put in 8 months or a year's worth of property taxes that you're going to owe into an account so that you don't fall short, so that we have enough money to pay your property taxes at the 2 times we have to pay the county.
Like 20,000.
It depends on the price. It's based on the percentage of tax. But here's the thing: if you have to take 20,000 maybe and put it into an impound account, that's $20,000 less you have for down payment or for repairs, and you've lost control of your money, as Melanie pointed out. More money than just the amount of tax. You're like prepaid it, so you're constantly going to have not be managing your money the most effective way, because there's a lot of other things you could do with that money, as we just talked about. So it is not beyond our job to have a conversation with our buyers where we say to them, if they're 10% or more, do you really want to have an impound account? Because you don't have to, right? But for some people, as Melanie pointed out, they don't want to forget. Maybe the amount doesn't matter to them. They just want to have one payment. Understandable. And that may be their thing.
The PITI that I think that sometimes people do, even though that's what you just talked about, they can choose.
PI stands for principal, interest, taxes, and insurance, and that is the total cost of the housing. You're going to have PITI no matter how they choose to pay the property taxes. You're going to have PITI. The question is it paid through the mortgage every month, the full PITI? Or is it PI you pay in your mortgage and the T and the I are paid outside? But it doesn't matter. When you're qualifying for a mortgage, the PITI is the right formula, plus HOA fees and mortgage insurance. Well, that's for another class. But the point is, when you're helping a buyer to figure out how much they can afford in housing cost, those are all 4 of those things are elements of the cost, no matter how it gets paid. All right. So where do you get property tax info? There are 2 places that I typically look. The first is the property report. Now, it says CRS here. If you are in a different MLS service, your report might look different. This is the East Bay one. So this applies for Fremont agents and Oakland agents, but it does not apply for Palo Alto or San Francisco agents. They have a different MLS. So in your MLS, you can go to the tax area and get the tax information. And that's what I'm talking about in the first one. The second place where you can get tax information is in a natural hazard report. Almost all NHD reports, typically provided by the seller in a disclosure package, but not always, all natural hazard reports that are part of the sale process include a tax section. So here is a screenshot of the what it looks like for those of us in the East Bay. So you've got, this is showing 2022 and 2021, and it's showing a total assessment in 2022 of $253,210. And it's showing total taxes paid at the end of 2022 of $4,227.96, which is a very low property tax at that for that property. Now it is 4 years ago. This is pre-sale. I was representing the buyer, and the buyer was certainly paying a lot more than $253,000 for the property. So my buyer was going to see an increase in the property taxes, and we're going to talk about that in a minute. So this is where you look at it, and this is what it looks like in this report. This is a screenshot of a typical NHD report. These NHD reports include digital and physical calculators for your clients to figure out how much they're going to owe for property taxes. So if you look at this one, it says that the estimated ad valorem tax rate is 1.377%. Well over 1.0, by the way. That's ad valorem. That is what they're doing in this jurisdiction where this property is. It's higher than 1.1, higher than 1.37. That's high compared to many other jurisdictions. I don't know. I don't know. It's where it is. You're right. It has nothing to do with natural hazards. There's lots of things in the natural hazard report that have nothing to do with natural. But it doesn't matter. That's where it is.
That's a kind of hazard.
Well, yeah, but it's when you think of natural was the key word there. Anyway, the second part of this is the direct assessments. The direct assessments are $1,900 and nearly $2,000 a year in extra taxes for all those special things I talked about before. So this property is, I would argue, relatively highly taxed compared to some of its neighbors in other streets and other cities. So let's take an example. Let's suppose, I'm just going to move the box. Sorry, guys, you guys in the Zoom, I'm just moving you a little bit. Let's suppose it's a $700,000 sale price and the ad valorem tax is 1.377%, as we saw on the last page, with direct assessments of $1,888. We're going to do a little math, but just breathe deep. We'll be over soon. The first thing you do is you multiply the actual sale price by the ad valorem tax. That's $96.39. Then you add in the flat rate direct assessments. That gives us $11,627. And then it turns out to be 1.6% added together, and a monthly tax rate on this property of $968.92, nearly $969. So if they have a mortgage, their monthly payment for taxes, the T of the PITI, will be an extra $969 on their monthly mortgage payment. And by the way, that $11,600 that this new owner is going to owe at $700 is way higher than the $253 assessment that was on file previously. So the tax rate becomes very important. It's very important that you guys know what the modified tax rate is after all these calculations. In this case, it's 1.66%. Why do we care? Because when lenders do pre-approvals, they will typically use 1.25%. They will pre-approve your borrows based on an estimate. because 1.25 is closer to what the average is that we observe. Okay, that's what they typically use. Some use a little bit higher if they're selling in Berkeley, but or in Palo Alto maybe, but they typically use a rate. This is a problem. If the lender is you doing a pre-approval based on 1.25%, in the example that I just gave you, it's 1.66%. So the lender's pre-approval is not going to reflect the actual monthly carrying costs for this buyer at this price. So at 700,000, if the lender uses 1.25%, they're seeing a monthly tax rate of $729. But we know it's $969 based on looking at the NHD. So therefore, the borrower's monthly payment is actually nearly $240 more every month. This is something your buyer needs to look at. You need to look at with your buyer and have them talk with their lender if there's any question. Now, the better lenders get this right, okay? And they're getting better than they were 10 years ago. No question about it. Still, always check. Go to the NHD, crunch the numbers, and make sure that what your borrower is thinking is their monthly tax rate matches what matches what you've discovered it's going to be. Okay, and maybe you don't want to embarrass anybody. Call the lender first. Call the loan officer first and say, hey, were you aware that the actual tax rate here is not 1.25%? It's actually 1.66, and have the conversation before they remove their loan contingency, for example. That will show that you are covering your bases.
And that would be in the net sheet, right?
It will be on the loan estimate. The net sheet may or may not show it. The net sheet will show it if you've prepared one. But the lender, where you're very concerned is what the lender is telling your client. And also, if your buyer is buying all cash, then it will definitely be you telling your buyer what they should expect for property taxes. Many of your buyers get overwhelmed by disclosure packages. The disclosure packages are hundreds of pages long. This section of the NHD is one section that you should absolutely be drawing their attention to. They might miss it. They have so much to read. All right. Any questions about that before we talk about supplemental? Any questions from our Zoomers? No? All good? Okay. Let's talk about supplementals. So if that was making your head spin, now I'm going to make your head spin even more. Supplementals. So you don't need to do the math for this. There's online calculators. The NHD report will have a calculator. But basically what's happening here is that your property sale does not happen on June 30th. Your deal doesn't close nicely in line with the tax year. And remember how I was talking before about how they calculate it in the first part of the year, but they don't bill it till the fall, and you could potentially have sales transactions in between. So what happens is the loan gets closed, the property tax is at the right rate, but there's a period of time before or after June 30th that is not accounted for or adjusted for at the right tax rate. So what ends up happening is extra taxes are owed. So when escrow adjusts the numbers at the close of escrow, they do a proration to the day of close of escrow based on the current tax rate as known, not based on the new tax rate that the buyer is going to owe. So depending on when it happens, you run this calculator, and if the prices have been going up, if the buyer is buying a property that's more expensive than what the seller is paying on taxes, then the buyer's going to owe a supplemental property tax for this adjustment because of the screwy dates in the tax year. If the property values are going down, like we're observing in some condo markets, then it's the other way around. The county's going to write a check for the fact that the new market value, the new assessed value, which is always based on sale price, is less than the old one.
People who pay over asking are, less or more supplemental.
It is supplemental. It's not based on whether they paid over or less or under asking. It's based on what the sale price actually was versus what the day of closing of escrow was, and how much of a discrepancy that is from the previous owner. So if the property value increased, let's suppose buyer A bought it for 400,000, owned it a year, and had 2% property tax increase. Their property taxes, let's keep it simple. Let's suppose it was just 1% property taxes. At the end of the year, their tax was $4,000, and it's going to rise to $4,400. That's 2%. But if the property value went from, what did I say it was? Whatever the property value, oh my God, I'm getting numbers in my head, I'm getting mixed up. 400, that's right. I use 400,000. If the property value went to 600,000 or even 500,000 in a year, that's a 20% increase. So then they're going to have a supplemental because the new tax is going to be 1.1% of 500, which is 5,000. So that's $600 more. So there's going to be a $600 discrepancy. And there's a period of time where, and it won't be the whole 600, but anyway, it doesn't matter. The point is that because of the timeline, there may be additional taxes owed to bring it all even to zero, that the new owner is paying the appropriate tax rate for their full period of ownership. Appraisal doesn't have anything to do with it. All we care about is a closed sale. Closed sale and closed sale price. Okay? So, your job, guys, is to take a look at this calculator and see what your client's exposure is. Okay? Then when you've run that, or tell them to do it. Tell them to run the calculator. Warn them that they may get an extra property tax bill, and it's usually sent out in January or February, called a supplemental. Send them the CAR advisory. We have a whole page advisory on this because we're very worried about it. And also send them to the statewide buyer and seller advisory form, page 11, item 8. I'll show you both in a minute. You're going to get a copy of this presentation, yes. You have to click it at the end. You'll click it. You'll see. Now, here's the deal, guys. This could potentially get your clients mad at you. When you are in escrow, you should remind them about supplemental. When you write the offer, you're going to send them these advisories. You remind them then. It's in the seller disclosure package. Remind them then. After you close escrow, in the months right after you close escrow, send them an email saying, hope you love your house. Remember, you're going to owe supplementals. And then you might even want to have a conversation about it. Because the last thing you want is for your client to get a tax bill in January, February, after you've sold them the house, and to phone you and say, Mike, I just got a tax bill for $4,000. What the? Why didn't you tell me that this was going to happen? Like, I don't understand it. You don't want that. You want to be ahead of it, which is why I make a big fuss of it. Here is a screenshot of this NHD report with the supplemental tax calculator. You don't have to do the old-fashioned math anymore. Just click the QR, click the link in the NHD report. But now it's getting even easier. You can simply give the data you have to your friendly neighborhood AI, and it will crunch the numbers for you right there and then automatically. So you don't even have to use the NHD report anymore. This is the ZIP forms. This is the form. California property tax law requires the assessor to revalue real property at the time of ownership property changes. Because of this law, you might receive 1 or 2 supplemental tax bills, depending on when your loan closes. The supplemental tax bills are not mailed to your lender if you have arranged for your property tax payments to be paid through an impound account, which we talked about. The supplemental tax bills will not be paid by your lender. It is your responsibility to pay these supplemental bills directly to the tax collector. Call your tax office with questions and sign it. Now, guys, some lenders do pay them. So talk to the lender. The lender may pay it. But the point is, have the conversation with your buyer so they're ready. Okay? And you can actually tell them what they should expect it to be using those calculators. This is Section 8 on page 11 of the statewide buyer and seller advisory. So there's all this detail. I don't care about that. You just need to know to not let it be a surprise for your buyers. That's all I want you to get. Okay. You can read the detail of this later. All right. Are you ready to move on? Are there any questions about this? My Zoomer friends are good? Okay.
Supplemental is a bit adjustment, so
Yeah, it's an adjustment.
one time adjustment.
Yeah, once it happens once. It might come in two different bills, but it's one-time adjustment. All right, let's talk transfer taxes. Property taxes are, there's different types of property taxes, and another type is called a transfer tax. So this is a wonderful thing where the city or county charges a fee to the seller or the buyer or both whenever a property changes hands. And that's called a transfer tax. It's a one-time only fee. For the county one, it is in California almost always $1.1, $1.10 for each $1,000 of transferred value. So you take the sale price, 700,000 in our example, you divide by 1,000, that's $770. Sorry, you divide by 1,000 and you get 700. You multiply the 700 by a dollar, 1.1, to get the 770. But again, go to the calculator, put in 700,000, or you go to your AI and tell it what's the county transfer tax per year, or the county transfer tax on a sale at these variables. It'll do it for you. Now, in almost all of our jurisdictions, the seller pays all of this. It's a very small amount, usually under $1,000, maybe a little bit more for $3 and $4 million homes, but it's typically not a big amount. And that amount is usually paid 100% by the seller, but local rules, local jurisdictions have different rules on this. It is your job to know what the custom is in your area. In the East Bay, for example, the city of Alameda is always 50-50 on this. But almost everywhere else in Alameda County and Contra Costa County, it's seller pays. I think Vallejo in Solano County is also 50-50.
Can you look it up?
Ah, you can ask your friendly AI. But if you're going to ask your friendly AI, make sure it gives you information from a title company website. You can call your escrow officer. You can look at the natural hazard zone disclosure report. It'll all be there. This cost is a closing cost, no matter who pays it. Either it's deducted from the seller's proceeds or it's added to the buyer's expense. Comes through the deal. If the deal doesn't close, obviously it's not paid, just like any other closing cost, or most other closing costs, rather. Now, there's a city one. Some of our cities in the Bay Area have it, and some don't. This is also something you need to know. Best and most authoritative source is your title company website. Chicago, WFG, Fidelity, Old Republic, those are the big ones. Orange, Lawyers, there's a bunch of title companies. This should be in the disclosure package as well. In most jurisdictions, but not all, it's a 50-50 split between buyer and seller, and it is negotiable, right? But the custom is, again, it's paid through a closing cost. Now, this one can be much, much higher. This one can be really super expensive. And the cities have been passing laws to say if the home is worth over $1.5 million or over $2 million, if it sells for a high number, then we're going to charge even more. Berkeley charges 2.5% for a home selling over, I think, $1.5 million. So imagine a $2 million.
1.7, I think.
Oh, okay. So what's the math on that, Brandon? 1.7.
I think that last I heard was 1.7, but
Okay, I thought it was
not absolutely
more.
sure.
Yeah, okay. So let me show you how I would resolve this problem right now. One sec, guys. I need to show you because this is just instructive. So the question is, we go to our friendly neighborhood, Mr. Google. What is the city transfer tax in Berkeley? Okay, 1.5% at property sold below 1.7 million and 2.5% per property sold above 1.7 million. So you were right, close, Brandon, you were close on one of the numbers, but you had it in the wrong place. The percentage is what I was talking about. You were talking about the threshold amount. Maybe not the wrong place. I may have misunderstood you. Doesn't matter. So let's say that a property sells in Berkeley. If a property sells in Berkeley for 1.8 million, 1.7 is the cutoff. How much is the city transfer tax? And the answer is $45,000. That's a lot of money, usually split between buyer and seller. But now we're talking about big coin, increasingly big expense for buyer or seller or both. See what it says in the detail. While negotiable, the city transfer tax in Berkeley is often split between the buyer and seller. Now we're talking about enough money that a buyer might say to the seller, Mr. Seller, I want to keep my property tax base lower, so I am going to pay 100%, or I want you to pay 100% of the tax. Sorry, I said that completely wrong. I want to keep my property base, property taxes lower, so I'm going to pay you. I'm gonna ask you to, okay, what a buyer will say is, since you would have had to pay half of this, 22,500, Mr. Seller, we normally split 50-50. I'm simply going to increase, I'm gonna pay 100% of it. That way, you can net the same amount of money at a slightly lower sale price. And that means my property taxes will be less going forward. So when a buyer presumes some of the seller closing cost, the seller can lower their price and still make the same amount of money. So it's a strategy we start seeing at higher price points. Anyway, that's a bit off topic. Okay, let's talk about these a bit more. How are we doing here? Oh, wow, it's almost 3 o'clock. Okay, so keep in mind that the city transfer tax is not charged by all cities. It's also paid through the closing. Let's move on. Okay, I promised I would talk about Prop 19. I want to talk about Prop 19. So I don't know, about 10 years ago, they passed Prop 19. And what they basically said is that if you're 55 years of age or older, or have a permanent disability, you can transfer your property taxes to a new property, as long as it's a principal residence. So anywhere in the state. This was a big improvement because previously there were only 8 counties that allowed you to transfer the property taxes. Previously you could only do it within your county, and only 8 counties allowed for inter-county. So now it's all over the place, and this is a complicated thing because a citizen's eligibility for a homeowner's eligibility for it is based on a bunch of variables that are personal to the individual, which is where our CPA comes in. So what you want to do with Prop 19 is refer them to the appropriate county website. You can send them to a website that allows them to estimate how much it is, like this one from your friendly neighborhood title company, and whether or not they'll qualify and how much they're going to owe on taxes on their new home if they're able to execute Prop 19. I understand from my limited experience with Prop 19 and my clients is that you have a long window of time after the sale to get it all corrected with the county. You don't have to do it before you've closed the deal. But I always tell clients for whom this might be a benefit to talk to a CPA, because unlike most of these things, this is really relevant. Who is buying, who is selling, what is the relationship of parties, and the proper assessment of the property that is being sold. And there's just all kinds of variables that make it a little more complicated than simply running the calculator. But you do want to know about it, and you do certainly want to talk to your clients about it, especially if it's principal residence to principal residence. Now, this doesn't apply, as I understand it, to investment properties. Okay. All right, guys. So I'm going to put the QR code up on the screen. if you click the QR code, you can get a copy of this report. You just simply need to answer a couple questions, and you can get a copy of the PDF and, review the advices on it. But I also wanted to make sure that we had time for any questions. So we have about 10 minutes, so.
I'm confused about the city transfer tax, because, the transfer tax should only be 1.1%.
No, you're talking about the main ad valorem tax. Transfer taxes have nothing to do with that. There's two types of taxes.
1,000 is one, how can you go back to the size back? It's for $1,000, you pay.
Transfer taxes.
$1.1, so that's essentially point.
This has nothing to do with ad valorem.
Yeah.
This has nothing to do with it.
1%, right? 1.11%, that's the county transfer tax. The
Right.
county transfer tax.
0.011, but okay,
0.011%.
yeah.
And then that's the county transfer tax, but the city
It
transfer. tax
is the same, is also per $1,000. I didn't give an example because it varies so much. It depends on the city. Every city has a different, and some cities don't charge at all. Well, it's Berkeley. In other jurisdictions, it's less. Yeah, the county transfer tax is really, really small. And I think that's a result of the legislation, because part of the goal of Prop 13 was to make it hard for property taxes to be raised by the county. But cities can pass laws and do stuff for their own cities. So over the years, cities have ended up charging a lot of money on transfer taxes to make up some of the money they aren't getting from the county anymore. So it's a lot of politics in this. But yeah, the discrepancy is dramatic. County transfer taxes are teensy tiny. And there may be actually, Melanie, a relationship between the 1.1% we see on the transfer fee and the 1.1% we see on the ad valorem. There might be a relationship. It may be part of the same law that said the counties can't charge high transfer taxes either. But I don't know. I don't know about the origins of the numbers. I wasn't living here in 1970, whatever years, 77, 75, whenever it was.
Where were you living?
I was living in Toronto, Canada.
Really?
Yeah. Any other questions? All right. Well, thank you guys all for being here and for coming, for you guys from Fremont and Palo Alto who hung out. And we are done.
Thank you.
You are most welcome. Oops, I didn't want to do that. Stop share. And let me